Good afternoon. Welcome to Asset Strategy Consultants webinar on blockchain technology. My name is India Suter and I am the Director of Business Development here at ASC. Our goal today is to provide an overview of blockchain and place the technology into a larger context, moving beyond Bitcoin and NFTs to discuss the promise of internet software decentralization and opportunities for institutional investors. We are fortunate to have with us today Atul Rustgi. Atul is a partner at Accolade Partners, a $3 billion venture capital and growth equity fund of funds located in DC. Accolade has raised 2 prior blockchain funds and is currently raising an open-ended fund dedicated to blockchain investing. Atul has graciously agreed to share some of the insights he has gathered on this topic. Our moderator today is Andy Connor. Andy is Chief Investment Officer here at ASC. He oversees our outsourced investment office. Our format will consist of 45 to 50 minutes of conversation with Atul, followed by an opportunity for questions from the audience. Let's get started.
Maybe we'll talk about 5 different areas as we progress through this. As I say, I've really only begun to scratch the surface in this area. I know Atul has kind of gone down the rabbit hole, but we'll start from the beginning, basically defining what a blockchain is and what the technology is and some of the promise. Then we will spend a little bit of time on Bitcoin, which is probably the area that most folks on this call are most familiar with. And then move into NFTs and also fungible tokens and just tokenization as a concept. And then talk a bit about Web3 and some of the promise there. And then maybe, if we have time, talk about alternative business models that are enabled by tokenization, including DAOs, and then talking about some of the areas like DeFi, where you've seen some opportunity for institutions to invest. So to start off, maybe if you could just define what is blockchain technology and what is a blockchain?
So first, thank you for having me on this. Pleasure. Always happy to chat about blockchain and crypto. It's a very hot topic nowadays. So what is blockchain? At its core, I wanted to set the table that blockchain is a software. It's based on software. A lot of people view it as some alien technology, something that's very unique and different. But at its core, it is software, and it's specifically open source software. So it is not some brand new technology that never existed before. It is simply open source software that does exist today. The difference with it is that it's using open source software to enable a decentralized business model. Majority of the businesses we encounter today are centralized. All the people that create the value, which are the customers and the stakeholders, don't actually capture the value. It's the central organization that captures the value. It's their shareholders. They accrue all the economic upside. They're the ones who make all the decisions. What blockchain is trying to do is flip that on its head and to create a world or a business model where the people that create the value, again, the users, the customers, the stakeholders, actually capture the value. And the belief is, if you do that, these companies will have they become better companies, stronger network effects, and therefore bigger companies. And the belief is that blockchain and the decentralized business model can be as disruptive to centralized businesses in the same way online was to offline, SaaS was to perpetual licensed software, or mobile was to non-mobile. And that when you look at a lot of the businesses today, from financial services to Web 2.0, a lot of those companies would be, one, more capital efficient and just have a better service and product in a decentralized manner. Now, the way that is enabled is through this token. Most of the time we hear about this token, for most of us, it just feels like a way to, it's a liquidity feature where you can buy and sell the token, flip a token. While it does have a liquidity function, for the blockchain companies, it has very much a utility function, meaning that token, when given to its stakeholders, its customers, developers, that token gives those people 2 things. One, it gives them a share of future revenues, and it gives them a right in terms of governance and voting. Both of those, the belief is that it creates stronger loyalty because you're incented to use the product more, contribute to the product more, because you're getting upside on revenues and you have a vote. The company becomes what you want it to be.
So it sounds like equity, right? I mean,
So,
essentially.
and some it's more it is equity, but maybe on steroids, right? So when you own equity today, it technically gives you a right to future cash flows. Not every company issues dividends, but technically you have a right to future cash flows, and you have a vote at the annual shareholder meeting. Here, it's just more pronounced, where these companies have the ability to send money back in a more direct manner. And then the voting mechanism can be more active. But if you give that, again, if you look at the average cap table of a company today, it's like 20% owned by the founders, but the rest go to just public shareholders or private shareholders. In the blockchain world, 20% go to the founders, 20% to the early investors. The remaining 60% goes to its customers and its stakeholders. So it's taking that equity from just traditional equity investors to actual stakeholders. And by transitioning that over using the token, it just creates better companies, stronger network effects, bigger companies. One thing I do want to clarify is when people think blockchain, and I know we'll go to this at some point, they just think Bitcoin, they think currency. And I want to let you know that that was very much the case 3 to 5 years ago. Bitcoin was the only game in town. That is not the case today. Today, blockchain, there are hundreds of use cases, thousands of companies that have nothing to do with Bitcoin, nothing to do with currency. They're using this decentralized business model to disrupt other areas like financial services or Web3 or NFTs or gaming, which we'll talk about. But I do want to, confront that misperception up front, because most people think this is just Bitcoin, it's just currency. It is way more than that. That's like me saying to you, Andy, your job is just investing in gold. You do way more than that. So blockchain has much more depth and breadth than ever before.
So I think of it as a database, really, that's decentralized, right? So rather than hosting your database at Amazon Web Services or some centralized server farm, it's really executed on many, many computers throughout the world, really. And the people who are doing the executing and lending their computing power are getting tokens in return. And
that's one part. And then also the customers who use the product also get tokens. So everybody that's contributing to the system, it could be hardware, it could be software, whatever it may be, or just activity, being a customer, in turn for that contribution, you get tokens, which again gives you a share of revenues, a voting right, and that incents you to contribute even more and make sure the system's great. So there's this positive a cycle that happens where as the companies are successful, people want to contribute more, want to make it more successful.
And so, in some of the reading I did in preparation for this, I came across this thing called, I don't know if you've heard of this or if this is just something I've read, the blockchain trilemma. So there are 3 kind of characteristics, and if you put them in a triangle, you've got decentralization, security, and scalability. And so you have those 3 things, and really there are trade-offs between the 3, and you really can't necessarily have all 3, at least today, right, in the way that you'd like, but you can improve over existing centralized web applications by using a blockchain.
And like Bitcoin's a great example of that. On that trilemma of speed, security, and decentralization, Bitcoin prioritizes decentralization and security.
Right.
And to do that, it sacrifices speed.
Right.
And so when Bitcoin first came out, yes, it was the thought was that it could be a currency, that it could be used on a day-to-day basis. But people realized real quickly it doesn't have the speed to facilitate 99.9% of transactions today. And so now Bitcoin's use case is more a store of value as a replacement of gold, but not currency. And so you'll see across the gamut within blockchain, across those 3 dimensions, usually a company might have 2 of the 3, but not the third. So again, all the layer 1 protocols like Ethereum, Solana, Near, which I equate to as operating systems. We're all familiar with operating systems like Apple has iOS, Google is Android, Microsoft has Windows. You need an operating system upon which you can make applications. It's basically the settlement layer. If you've heard of things like Ethereum, Near, Solana, those are all operating systems, but they all on that trilemma optimize for two of the three things. And so they all might have different use cases. Like one might be better in financial services, one might be better in Web3 or gaming, because what they optimize is perfect for that end market.
Right.
So you have various operating systems out there, or layer ones, that all fall on that trilemma.
It feels very much like a classical disruptive technology. So if you've read Clayton Christensen, really the idea is that you have new applications of technology that are actually inferior to the existing technology, but the speed of innovation or the improvement is at such a, so traditional technology is really incremental improvements, and then disruptive technologies have this opportunity to really improve at such a fast pace that they eventually overtake and take down these big incumbent companies or industries.
Yeah.
And this feels a lot like that.
I mean, and you see it now. I mean, even in something as like an exchange. I mean, Coinbase, even though people think that's kind of the poster child of blockchain, it actually is not a blockchain company. It's not decentralized. It's centralized like any other exchange would be. Has thousands of employees, raise hundreds of millions of dollars, very bureaucratic type of organization. And there's a company called Uniswap, which is a decentralized exchange using blockchain to provide the exact same service. It raised a fraction of the dollars, like $11 million versus hundreds of millions. It has 20 employees versus 3,000, and it's doing about a third of the revenue of Coinbase. Like in every shape, every respect, it's better, faster, and cheaper. You see that in the lending space. There are companies called like Compound, which is a lending platform. It's better, faster, and cheaper than any current lending platform at a bank. Loans are approved within seconds. There's been zero defaults. The cost for these loans is a fraction. So any software upgrade, usually software and technology gets better and better and better. Blockchain is just the next evolution of that. And even as something as simple as web browsing. I know a lot of people use Chrome or Internet Explorer. When you're working with companies like Facebook and Google, we all know there's privacy issues. They collect all your data. You have no right to it. And any ad you see, they take all the revenues. On the flip side, there's a company called Brave, which is using blockchain. They allow you to protect all your data and store all your data. And if you happen to see an ad, you share in the revenues. So, and again, in every respect, it's better than the current web browsers. And they're all growing rapidly. And at some point, if they really find product market fit, they can overcome these incumbents.
So maybe step back and just describe why decentralization is a virtue.
Because it just creates stronger loyalty and network effects. So in the current world today, when you view a corporation, they give you a product or a service, but they're extracting value. It's a transaction. And for many customer to corporation transactions, there is some level of attention. You don't think they have your best interests in mind. They're not really representing you. And you don't feel invested or have really vested interest in the company. With a decentralized business model, you are the company. The customer is the company. All the stakeholders are. They share in all the upside. So as the company does better, you do better. So you're more incented to use the product over and over again. So it creates much stronger loyalty, much greater network effects. And two, because you can vote on the governance, the company becomes what you want it to be. When Facebook determined their security policy, Mark Zuckerberg determined it. And along the way, really frustrated or annoyed almost every customer they had. Imagine a world where the privacy policy was determined by the constituents, by the stakeholders. They're more inclined to use the product and be loyal to it. So it's a very symbiotic process where the relationship between the customers and the corporations almost starts melding together. And there's just much greater upside because of this loyalty and network effects.
And so on the topic of Bitcoin, which, as you mentioned, these coins or these crypto currencies, which actually maybe is a misnomer that just kind of goes back to Bitcoin being.
Yeah, and I can quickly touch upon that. The term cryptocurrency came because when Bitcoin was the first thing invented, it was based on cryptography, which is the technology of blockchain. and it was supposed to be a currency. So they called it a cryptocurrency.
Mm-hmm.
Then it morphed into what it is today is just anything with a token, they say cryptocurrency. It's just,
Right.
it's semantics at this point.
Yeah. And so token's probably a better term.
So token is more applicable. But when people that are living and breathing this say, they'll use the term blockchain, crypto, tokens synonymously. There's no difference now. It does not mean it doesn't mean just Bitcoin. It doesn't mean just currency. It means anything blockchain related.
Mm-hmm. So Bitcoin, as you mentioned, and Ethereum and the others are not only, I mean, they're a token, but that's also a network, or as you called them, an operating system. So a platform on which you can then build additional services.
Yeah.
And go ahead. So to return to Bitcoin and your analogy of gold, right, as a store of value, I think that's really apt in a lot of ways. And not least being I've invested in a gold mine, and I've been to a gold mine where they're essentially big, heavy equipment that's pulling ore, out of the ground and then piling it up. And then they use cyanide of all things, which they filter through, which kind of pulls the gold out and it goes to the bottom of the pile. And just the tremendous environmental concerns. And there are
sounds very energy intensive.
Right, absolutely. They're turning diesel fuel into gold, and in some ways we're turning coal burned or natural gas power into Bitcoin, because it is very energy intensive. And I wonder if you have some thoughts about
the whole conversation around like the environmental impact of blockchain really does center around Bitcoin. Because the way to mine Bitcoin, and mining in a software, in a kind of tech way, not a physical mining, but the way to create and mine Bitcoin is the way it was built, because it's prioritizing security, is that in order to facilitate the creation of Bitcoins, the people that mine them have to solve these very complex math problems. And if you're able to solve it, you're able to create Bitcoin for the system. But in order to solve those problems, it requires a lot of hardware and energy to do that. And so we're at the point now where you need to be really of scale with the best technology, the lowest cost of energy, to effectively compete to mine these Bitcoins. Otherwise, it's a net loss proposition. If the energy is too expensive, if the hardware is too expensive, like, you'll lose money based on where Bitcoin is trading. That is very energy intensive. And so when people think about the environmental impact, it really is around Bitcoin. Now, in a weird way, China banning Bitcoin mining was a great thing. One, we don't want China to have such control over any technology, and they did have a majority of the mining at one point, but now it's all left or leaving, and it's going to areas like North America, even Canada, where they can actually use better energy sources. In fact, there are reports out there that over 50% of Bitcoin mining uses renewable energy. So in a weird way, the need to mine Bitcoin is fueling investment in renewable energy, because people are using that as sources, whether it be hydro, solar, you name it. Hydro is a big one, where people use hydro technology to mine Bitcoin. So in a roundabout way, it's actually fueling investments and interest in renewable energies. Now, outside of Bitcoin, most of the corp companies you see out there do not, their nodes that are doing the mining don't do it in the same way as Bitcoin does. Instead of being an energy and hardware approach, they use software, where it's not very energy intensive. So blockchain in general, outside of Bitcoin, is like any other software program. It's very energy efficient, and not a tax on the environment.
Great. So maybe we can move on to talking about NFTs. We talked a little bit in advance of this call. I know this is not your the area that you specialize on too much, but maybe NFTs and the opportunity for creatives and the ability to own your content versus, like, say, putting it on a platform where you just get a very small share of the economics.
So the three big areas in blockchain right now from the application side, one is decentralized finance, which is trying to use the decentralized business model to disrupt financial services. Second is Web3, which is using decentralized business model blockchain to disrupt Web2, which are all the social media sites we've seen over the past 5-10 years. The third area is NFTs and gaming. And what NFTs basically is it's a short form of non-fungible token, which means these are tokens where you can actually see ownership and a history trail of where that token has been. So it has unique characteristics that are identifiable. And in the kind of creative world, it could be very powerful in a few ways. One, if you're an artist, or whether it be like making actual art or a musician, in the world today, if you make music or you make a piece of art, your income comes from that initial sale. If it's ever resold, you don't get any of the upside. With NFTs, you're able to embed royalties into it. So if it trades hands, you can then get 10%, whatever percentage you want, depending on how you embed it. You get some percentage of the incremental value that it creates. And so that could be very powerful and very enabling for artists, whether it be musicians or artists. Other ways that these tokens, these can become social tokens, where if you're a fan of an artist, like the first 100 or 1,000 fans get access to this, and they gives them special rights to events, to backstage interviews, whatever it may be, first rights to songs. And depending on how valuable that artist is, those tokens can increase in value. And so it could be another source of income for artists. So NFTs, there's a lot of activity going on there. It is primarily on the creative side. Where it's also filtering into is the gaming side, where as kids and people spend more time gaming, and a lot of these games are becoming social networks for kids, where they interact with friends in these games, but they spend money, spending money for entertainment. Now that money can be spent on actually accruing assets that can increase in value. You can use in other games, you can trade. So instead of just burning money for entertainment value, that money is being spent to actually accrue assets, digital assets.
And so just thinking skeptically about it, and people spending money online in games or just to have property or status in some online world, I mean, is that a symptom of an overwhelming amount of liquidity in the system and people purchasing not only tangible luxury goods, but now digital luxury goods?
I mean, to some extent, I think a lot of what we're seeing today is a matter of a lot of money in the system. But I do think there's a generational shift. I mean, I used to game as a kid with simple things as Atari and Nintendo. Mm-hmm. All of those systems have evolved today. In fact, one stat I heard yesterday, in the US, the average age of the people that are in the gaming world is low to mid 30s. So these are people that actually find value in this. This is entertainment. You and I might watch sports. You and I might go to a comedy show, or for them, this is their entertainment. This is, and so it's not just a young person's thing anymore. I mean, it's getting into the early to mid 30s, and the way games are played have evolved. It's not just play a game once, move on. Like, these games live in perpetuity. It's way more interactive. It's way more social. And for that, NFTs could be very powerful.
Mm-hmm. And you mentioned sports. I think I saw that the NBA is actually the #1 issuer of NFTs.
Yeah, so they were early on. I mean, another way to think about NFTs is digitizing sports trading cards. Mm-hmm. A lot of us might have had trading cards when we were kids, the physical cards. Now they're doing digital versions of that. And the NBA was at the forefront with a thing called NBA Top Shot, where people could buy effectively digital trading cards of video highlights of NBA players. And now the other leagues are signing up with with Dapper Labs as the company behind it, to do their version of NBA Top Shot. So you are seeing more and more of that happening.
Mm-hmm. Great. So maybe change gears again and talk about Web3. And I think if you'll allow me, I'll just talk about maybe 2 iterations of Web 1 and 2, and then you can talk about the promise for Web 3. Web 1.0, I mean, I remember when I showed up in college getting on the internet for the very first time and didn't even know what a search engine was yet. It was very, it was very open. The protocols, like if you knew how to write code, you could put a web page up. But it was also, it was fairly unconstrained. It was also really right only, not read only, not read and write. And so it was like an online magazine where you're essentially looking at static content that's provided at a point in time, and it wasn't particularly dynamic, but again, totally open, where again a college student could just put up a website. Nobody may visit it, but it was fairly accessible. And then Web 2, so maybe that was the late 90s to the mid 2005, and then say around 2000, early 2000s to today, this Web 2.0, really characterized by the rise of these big platforms. So obviously Google, but more Facebook and Twitter, even eBay, where there are these centralized, very big platforms that have enabled read and write, so that the user can provide content like tweets or for YouTube videos that they make. And so it's much more dynamic, but all of the lion's share of the economics were accruing to that platform. And I think it was Chris Dixon has this S-curve schematic describing the rise of platforms, where at the beginning, when they're hyper growth, they're trying to attract users and get everybody onto the platform, create these network effects. And then once they reach critical mass and have grown to this scale, they turn their attention from attract to extract, and then they're pushing price because they can, or acquiring and vertically integrating, acquiring their competitors, or utilizing user data for their own purposes. And so really that, I think, if you agree with that construct, is really Web 2.0. And then I think Web 3 is really kind of pushing back against that construct.
Yeah, I mean, I had the same experience in college with Web 1.0. It's simply put, it's a static website. It's just, there's content, there's nothing much you do with it other than read it. Web 2 is interactive, where there is a dynamic between you and the website and other people on the network. What Web 3 is trying to do is solve those issues that you mentioned about extracting value. Mm-hmm. And the way it's doing that is taking the Web 2 concepts, but make them decentralized. So, a company like Facebook has all these great customers, all these great users. Instead of extracting value out of them, give the value back to those customers. So as I said, in the centralized world, the people that create the value don't capture the value. In the blockchain world, the people that do create the value capture it. And so what Web3 is going to essentially try to do is say, let's put the power back in the hands of the users. If you provide servers for the system, we give you tokens. If you are an active poster, if you actively post on Facebook content that people like, we will give you tokens. Any type of policy we want to implement, we give you the right to vote on it. So back to my earlier example, when Facebook needs to determine its privacy policy, instead of Mark determining that, because he wanted to extract as much value from those customers as possible, let me keep their data, let me sell it to third parties so that I or Facebook can generate all of these profits. Let the users determine that, and I'll share those revenues with them. And so it's basically taking a lot of the same concepts we have today. You could look at something like Uber, Twitter, Facebook, you name it, in a decentralized fashion. The network effects are stronger, the revenues are bigger, the companies are bigger, and the customers actually like using the product. Mm-hmm. A lot of people use Facebook despite it. In the blockchain world, you'd use Facebook because it's exactly what you wanted it to be, and you feel like you are an owner of that company.
Mm-hmm. So that's an interesting value proposition for the customer that I could see, drawing users.
Yeah.
But Web3 is also drawing huge amounts of talent from Silicon Valley. People are just working on these projects and leaving these big platform companies who are very successful, and they generate huge earnings and they pay very well. So I wonder if you could just talk about on the talent side, what is drawing people into the promise of Web3?
So I think two things. One, they see this is where the future is going, right? So they don't want to be in yesterday's technology. They want to go in tomorrow's technology. So I think at one end, a lot of the talent sees that this is where the market is moving. And so I want to be at the forefront of that and hopefully, become wealthy as part of that. I think a second big reason is mission driven. I think a lot of the younger talent at these big corporations understand how The younger set of computing engineers, all that, they are much more mission driven than the older generation. And they truly believe in what Web3 will deliver from a values perspective, from an alignment perspective. And so we're very much seeing not only at the college level, but post-college level, the best talents now migrating to blockchain. A lot of the top universities have cryptography courses. They're all sold out. Most of the top engineers at these universities are going straight to blockchain. And interestingly enough, for most of them, they've never known a world without blockchain. The blockchain was around when they were in high school, definitely while they're in college. So they're more crypto native than any of us are. Like they've been living and breathing this for a good part of 8 years. So for them, it's not this brand new thing. It's like natural for them to step into it. But you're also seeing now from the traditional tech world, particularly Web 2.0 operators and engineers are saying, I see where the puck is going. And they're now moving over to Web 3. So it's really exciting. I mean, I think Bill Gates said this many years ago. Look at what the teenagers are doing on the weekends. We'll all be doing that, full time or all the time, 10 to 20 years from now. And I think that's exactly what's happening here.
Mm-hmm. And I mean, you got this idealism surrounding it, and I know there's been some debate between, say, Jack Dorsey on one side and Mark Andreessen on the other, and kind of the purity of Web3 versus like using it as a place to invest and make money. And I wonder, these platform models have been so successful because they work as economic models, and at least up until now, they've worked for the users where, it's easy, it's convenient, and everyone's there. And so people have kind of been willing to just surrender their data. I wonder, what creates the tipping point, or if there is one, and also if these idealistic Web3 companies don't eventually just become platforms themselves, right? Because that's human nature.
Yeah, I mean, look, there very well could be some unintended consequences from all of this that we just can't think that far and see. But it's more than just idealism. I mean, there's a financial role here too. I mean, these companies will generate revenues, and there are ways for investors to make money here. As I said earlier, like the entrepreneurs aren't coming here just for the idealism part. They actually think they can get wealthy here. The thesis is that these companies will generate more revenue, be bigger market caps than their centralized version. So there is a lot of returns to be generated here by either being an early investor in these companies, and usually, as I think I said this earlier, early investors get 10 to 20% of the cap table. You can be an early investor there, just like you would have been early in Facebook, Google, whatever, and generate great returns. Or when these companies launch their tokens, as we said, like equity, a public market investor, you can invest in these tokens and say, look, I see where the user growth is going. I see where revenue is growing. Let me discount that back. I think it's undervalued. And so it's just a business model innovation. Mm-hmm. It's a decentralized business model innovation, but a lot of the other elements stay the same. Like these, and by the way, like many of these companies are way more capital efficient than the centralized version. I mean, they have 80+% EBITDA margins because they rely on their community and stakeholders to contribute resources. So in some respects, these are they're much better business models than centralized. So as an investor, that's partly what gets us excited, is that not only is this at the forefront of innovation, but we think we can generate some outsized returns by being early in this space.
Mm-hmm. And do you think that the end game for some or all these companies is eventually to be public companies, or is it to finance themselves and have ownership and governance structures as driven by the tokens?
So back to your equity comment earlier, when they launch their tokens, that is their IPO.
Right.
So there is no more, like, they're not trying to get acquired. By the way, you can't get acquired. They're decentralized. If you're acquired, inherently, you're not decentralized anymore. Mm-hmm. So this actually is existential risk to the big platforms today. That browser I mentioned, Brave, I mean, it's real existential risk to Facebook or Google. Uniswap is real existential risk to Coinbase. Like, they can't acquire their way out of this, like Oracle has done for decades, just acquiring companies, putting those products through their sales force. Here, These blockchain companies can really take down the big incumbents 100%. But that moment when they launch their token, that is their IPO. And they don't need to raise capital after that because it's decentralized. And so there is no other big milestone other than just getting bigger and becoming more popular, having more customers. There is no M&A event. There's no other IPO. Like, that is their IPO event. And if they need resources, their community will provide it.
Excellent. So talking a little bit about alternative business models, maybe if you could explain what a DAO is and how that fits into this.
Yeah, so it's basically it's a decentralized organization. Think of like a guild, or like if anybody's a member of REI, like a co-op, where the members are the owners of the organization. And that's not too deep. That is similar to what we are talking about with Web3, where the customers are the organization. So a DAO is an organization where yes, all the members are owners of the organization. They contribute their activity, and in return, they share in the upside and in the returns.
And how do they organize? Like, how do they come together? Like, what's the mechanism by which these people get together?
Yeah, I mean, it's kind of like, how do people get together around around Facebook or any other social media platform? Some entrepreneur will create this DAO and have a mechanism by which people, like if any other affinity group, people can then apply and get in and be a member. I could see investment firms switching to DAOs too. Like, you're seeing this more and more in Silicon Valley, where entrepreneurs are the ones pulling their capital together to invest in the next generation of entrepreneurs. That in the respect is a DAO. It's, the entrepreneurs are providing the capital. They're the ones who pick the companies. They're the ones who add value. They don't need outside money. They don't need other venture capitalists. So you could see investment groups becoming DAOs. You could see any affinity group becoming a DAO. And so you're seeing that emerging more and more now today.
So maybe we could spend a little time talking about actual investment opportunities for institutions and how you're approaching it, and maybe a little more specificity. Sorry, DAO is DAO, Decentralized Autonomous Organization. So Adam Dell, who's Michael Dell's brother, but also a technology investor in his own right, said, it is inevitable that blockchain will become the operating system of the global financial system.
Yeah.
And so maybe talk about DeFi and some of the promise for those types of disintermediation.
Yeah. And by the way, the St. Louis Fed put out a report about a year ago that said blockchain, and I quote, is a paradigm shift, unquote, in financial services that will unleash innovation in the space. So that I've never seen the Fed put out such a piece of commentary on emerging technology, but the St. Louis Fed said that about blockchain, particularly in DeFi. And by the way, the DOJ under a couple years ago, under Trump and Barr, put out a report that said cryptocurrencies will change the way humans interact and societies are organized. To me, again, shocking that I would ever see, and that was in the first paragraph, that the DOJ would put out such effusive commentary on an emerging technology. So in the realm of DeFi, and what DeFi is decentralized finance. So using the decentralized business model of blockchain to disrupt centralized finance, or traditional finance, as you may hear, TradFi. A lot of the centralized financial services companies today, as the name implies, are centralized. They're bureaucratic. They extract value out of you, and you're very reliant on this middle person. With blockchain, you blow that all up. It's more peer-to-peer based on the algorithm of the company. It's way more. It's faster and much cheaper than the centralized version. So the example I use is borrowing and lending. Today, if you want to lend money out as an institution, you have to raise hundreds of millions of dollars, which is dilutive, to then lend out. If you want to get a loan as a customer, first you have to have access to the banking system. Not everybody does. Next, if you do want a loan, it can take weeks to get approved because of the bureaucracy. And third, if it's approved, they take a big fee to cover all their red tape and bureaucracy, or overhead. Sorry. There's a company called Compound. There's other ones like Aave and others that do this in a decentralized manner. First and foremost, they don't have to raise hundreds of $1 millions to loan out, because if you or I have excess capital on our balance sheet, we can contribute it to their liquidity or lending pool, and they lend it out. They give us Compound tokens in return, and that token gives us share of all the interest accrued. So we can put our unproductive assets on our balance sheet to use, and in return, we get a return on that. And so they don't have to raise any money to then lend out. So very capital efficient there. Two, anybody has access to this. It's on the web, so you don't need access to a banking system. Anybody can access this. Third, their loans are approved within seconds, not weeks. And fourth, the fee they charge is usually 5 to 10% of whatever traditional bank would charge, so much cheaper. This company, I believe, has raised like 20 million bucks, has 20, 30 people on staff, and is doing hundreds of millions of revenues and 80+% EBITDA margins. If I am a big bank CEO, just like I would upgrade any of my underlying technology platforms, if a better technology comes out, maybe a different software, whatever, maybe this is an upgrade in software. It's just a different business model being decentralized. I would rip out my old system, slide in this blockchain version, maybe white label Compound or white label Aave, and I can then tell my customers, my clients, look, we have something that's better, faster, and cheaper than any other competitor. You should use our lending platform. So I fully agree. And Jamie Dimon, I think, has been on record for saying this too, that blockchain and DeFi could be very disruptive to financial services. So I think there is more and more consensus that blockchain will be the operating system for all of DeFi or all of financial services at some point going forward.
Mm-hmm. And in that case, with Compound, for example, when you remove humans from the equation, how does the underwriting, right, and the credit risk, how is that adjudicated?
So it's algorithmic. Right now on Compound, it's everybody has to over collateralize any loans that they want to borrow. So not very efficient per se. But now there are companies that are experimenting with under collateralized loans, which would then expand the market dramatically. So if it's over collateralized, it's very easy that you can call in the loan if there's any impairment. But with under collateralized loans, they'll use other sources to make sure with regards to the default rate.
So because they've cut out so much overhead, you don't need to lever up your balance sheet to be profitable.
They don't. I mean, again, they have 80% EBITDA margins. No need to.
Right. Understood. And I agree with you, which is financial services. Ultimately, I mean, the upside associated with disintermediating is huge, because it's an entire industry of middlemen, right? I mean, we're all at some level.
We all are middlemen at some point, right?
Middle people, right? And so, however, it's also a highly regulated industry because you're dealing with people's savings and their wealth,
yeah.
and so talk about not only the HR requirements associated with complying with regulation, but like what happens if one of these blows up, right? And there's a number of defaulted loans and people lose their savings.
So the regulatory bodies have been pretty clear that the one thing they worry about is KYC. Mm-hmm. Just know your customer. And so a lot of these platforms like Compound and Aave are already, even though there is no formal regulation around it, they're anticipating it. And so they're already implementing liquidity pools where there'll be much stricter KYC functions. And so the big banks can actually start coming on board. The early day version is it was anonymous. There was no KYC. So anybody could trade or anybody could borrow and lend. Fortunately, like there has been no defaults because of the way the algorithm is set up. But in order to go truly mainstream and to be a possibility for institutional capital, these platforms like Compound Aave understand what the regulatory requirements will be at some point. And so they're proactively creating separate pools of liquidity that comply with KYC regulations. And so now institutions can come on board in those pools and still get the same technological efficiency and advantages that you would with regard to blockchain.
Mm-hmm. And KYC is know your customer.
Yes.
Okay, one final question from me, and then we'll turn to maybe some audience questions and they can steer the conversation a little bit. But given the sentiment of decentralization, kind of pushing back against these big incumbents and these big platforms, and almost an anti-establishment, right, sentiment to this.
Yes.
Is this even really an area for institutions to invest their capital, or is that kind of missing the point, right? Institutions by their nature are centralized, and so is it a place for us to invest, or is that
100%? I think it's a place to invest. I mean, not just over the past 10, 20 years, but over 100 years, we've seen many innovation cycles, right? In many different shapes and form. I mean, you look at any technology that we think is ubiquitous today, there was a moment in time where it was disrupting an incumbent, and you could go back to some press headlines and they would have said, this emerging technology is bogus, it's crazy, like, let's have some more regulation to protect the incumbents. This is another iteration of that. And again, this is not some foreign technology. It's nothing crazy. It's software. It's open source software. It's just a decentralized business model versus centralized. When we went from offline to online, that seemed crazy. Now that is ubiquitous. Back in the day, we used to get the CD-ROM to install software. And now it's being delivered over the internet. That sounded crazy at one point. Now that's ubiquitous. Even having all your data on your phone and Uber and all this stuff. We believe that this will become ubiquitous at some point. And as an institution, just like you would invest in any other innovation cycle, I think one should, I know I'm biased because we have a product here, and I know I've fallen down the rabbit hole, so obviously take it with a grain of salt. But I truly believe this is the next 10, 20 years innovation. And any institution, any individual should have some exposure here if you want exposure to that innovation and disruption. Definitely. I mean, and you can invest in this just the same way you've invested in anything else. You can go in the public markets. I use quotes around public markets. You can buy, the tokens directly. If you have the knowledge, or if you have a manager that has the knowledge, you can go into the private markets, find managers that have good deal flow and can find these companies. I mean, all the same ways that you would in traditional private equity or traditional equities, you can invest in this similarly, just different funds. But I tell all my friends and family they should have some exposure. I would tell every institution too. Like, I'm not super old, but I'm old enough to have gone through a few innovation cycles. This has a lot of the same ingredients. So I think the next 10, 20 years will be an era of where we see just massive innovation in blockchain.
Excellent. And thanks again. India, if you could come back on, and I don't know if there are any questions.
We do have a few questions. So first, Web3 seems more in the AI space, allowing platforms and or technology to provide context, reasoning, etc., and decentralization as a kind of byproduct. Is this accurate?
I mean, you can apply AI to whether it be a centralized or decentralized company. I mean, that can be I would actually say that's more of a byproduct. Like, that is a service that the company can embed into their product. At the core of what Web3 and blockchain is in general is decentralization. That there is no central organization that has full decision making, extracts all rent. What makes Web3 or blockchain beautiful is the fact that it's decentralized. Now, depending on what company you're building, you can embed AI into that to make it a better product. But at its core, what Web3 or any like DeFi, NFT, gaming, all of it, even Bitcoin, it's decentralized.
Okay, next question. What does this all mean to mainstream investors, pension funds, and so forth?
Yeah, a little bit what I was mentioning. I mean, it's another area where one can invest and generate returns. And in our belief that this is where you can generate high returns. And so if that's part of one's mandate, I think there should be an allocation here. So it's an emerging area. It's like going back to the internet or the emerging of SaaS, where you could invest early on and generate some outsized returns. One can either do that today or wait till it's very mature and then start investing. But it's another area to invest. It's an area of disruption and innovation within technology.
Okay, can you explain application of gas fees within the context of blockchain? Do you see DeFi blockchain lending platforms move away from gas fees?
Yeah, so this is a bit more technical. As I mentioned earlier, a lot of what the term layer one protocols, Ethereum's consider that, Solana, Near, there are a bunch. These are what I would call operating systems. You need an operating system upon which to create applications. The way these operating systems work is that if you use them as a settlement layer, you have to pay a fee for every transaction. That is what these gas fees are. Ethereum at one point was not fast enough and got overloaded, and the gas fees became pretty onerous. And so they are trying to get to a point where it's way more efficient, way more scalable, and the gas fees are more manageable. So the gas fees is what creates value in these layer one protocols or these operating systems. That's how they generate revenue. So imagine if you're using Linux software, for every transaction, there would be some fee that you would pay for it to be the settlement layer for the operating system. So these applications need to use any of these underlying operating systems, and every time they use it, they will pay a gas fee for that. Ethereum right now is the dominant operating system for DeFi. It's not as fast as the industry would like. It's trying to go through an upgrade to make it faster. And then there are other platforms, as I said, near Solana, that are trying to compete and take away market share. So in general, we just think the gas fees are going to become much more reasonable, but there will always be some type of gas fee there so that value can accrue.
Okay, next, how can an investor determine the actual value of an investment in this technology?
Yeah, so if you look at areas like DeFi and Web3, I mean, the companies have cash flows. You can look at Uniswap, it has cash flows. Compound has cash flows, Brave has cash flows. And the beauty of this is because it's open source, all the data is public. With traditional public equity, you get data once a quarter. Private equity, you have to be an actual investor to get any data. Here, it's all public. So there are websites like CoinGecko or tokenterminal.com. It provides real-time data because it's all open source. You get not just day by day, hour by hour, minute by minute, but second by second updates on these protocols. And particularly in DeFi and Web3, because there are cash flows, you can do a DCF. You can say you could project out user growth, therefore revenue growth, discount it back, and get a present value. And at that point, you can determine, do you think it's overvalued, rightly valued, or undervalued? Much better ability to price these than private companies because the data is more transparent.
So I saw a question here, which I actually was thinking of myself, which is they phrased it at the beginning of the automobile industry. There were hundreds of car companies, and obviously only a few survived. And if we think back to the beginning days of the internet, there were thousands of .com companies. And
how many search engines were there? There were so many.
Right. If you invested in Webvan, you lost everything. So number one, how do you choose the winners, or how do you try to? And number two, if you think, how does a company build a competitive advantage in this space where everything is so modular and decentralized and open source, right? What's to stop new competitors from coming in and really just preventing the accrual of value to anyone?
So a lot of the answer to that question is similar to what we do in our traditional venture world. So at a high level, Accolade, how do we find managers? We talk to dozens and dozens of entrepreneurs on a weekly basis, and we ask them, who do you want to work with? Who are the top 5 firms? Who would be a dream investor for you? Who's the best in DeFi? Who's the best in gaming? Who's the best in Web3? And then you can triangulate on who the best managers are. Now many of these have been around for a few years. There's track records you can diligence. We also, and this is more subtle but important, like we like to see managers that are early stage investors. They lead rounds, not just participating, but leading the round and add value. So a lot of that's very similar to what we do in traditional venture. It's just in the blockchain context. For our managers, a lot of what they do kind of at a high level, qualitative level, similar. They want teams that have a big vision. They want teams that have relevant expertise. They want teams that might already have a beta product out that has a good following. So they're looking at a lot of the same elements. I mean, you talk to our venture managers, the number one thing they bet on, even more so than product and TAM, is the team. Because many of these companies might pivot, but you need a team that's hardworking, that's credible, that will run through a wall and get it done. So they look at a lot of the same elements here when they're backing a company. Like, is it a reasonable? Is it a great idea? Is it a big TAM? Is this the right team to prosecute that? And do they have the kind of the work ethic and network to get it done? So they look a lot at the same stuff. On your last point around moats here, the fact that it is open source, one can copy the code, make a few changes and start a new company. That will be the beauty here. I mean, there's going to be fierce competition in this space. But on the flip side, if you do get the right product market fit, it's going to be really hard to disintermediate, because minor upgrades here and there can be done by the community. So once you find kind of a lane that has a moat, it's really hard to disrupt, because it's a virtuous cycle where, as people start engaging with your product, if it's a good product, they're more incented to contribute and upgrade it even more. But yeah, I mean, one can just copy your code and start a new one. The company I mentioned, Uniswap, there was a company called SushiSwap that actually copied the code of its exchange and started a new company. But again, it's not just about the idea. It's about your go-to-market strategy. It's about the team. There's so many other qualitative elements. The three of us could start a Uber version on blockchain, and doesn't mean we're all going to be successful. Like, devil's in the details there.
Couple more questions. As an investor, would you view blockchain as a potential asset class, business model, something in between, or something else?
Yeah, I think it's ever changing, right? I mean, I think what I view this is tech. This is the sector is tech. If you look at tech over the past 20, 30 years, it was very hardware based. Then it went to like telecom and semiconductors. Then it went to the internet. I think this is just the next evolution of tech. From a sector specific, perspective, is this venture capital? Is this private equity? I mean, time will tell. I view this as tech and venture capital. So it's not a brand new asset class. This is just the evolution of technology and venture capital. Again, venture in the 90s was semiconductors and telecom. It evolved to the internet. It evolved to SaaS. It evolved to mobile. I think this is just the next evolution of tech and venture capital.
And last question I see, how do you understand some of the highly volatile and seemingly irrational values that have been ascribed to DFTs of some physical assets?
Yeah, I think you meant NFTs.
NFTs.
Yeah, look, out of all the categories I mentioned, between DeFi, Web3, NFTs, and gaming, the one area where there is more emotional exuberance and less tied to cash flows is NFTs, because it is like art, it's like music, it's a lot about scarcity, less so actual revenues being generated. The other three categories I mentioned have real revenues associated with them, and that's where I can, hang my hat on. Like I feel much more comfort there. NFTs is much more in terms of speculation. Now, can some of those NFTs transition into having specialized communities where those tokens give you access and there are revenues associated with it? Potentially. But a lot of the NFTs today is just purely scarcity value. But none of them have a real revenue generating business model. So out of the four categories, NFTs is the one where I'm not, I think there's a lot more speculation going on versus true revenue-based business models.
And we had one last one pop up. Can you talk about security and what that means in a decentralized environment?
Yeah. So any transaction that happens in blockchain has the same type of security as like a credit card transaction. So I assume all of us are willing to use our credit card online, and that's very secure. So the same type of encryption is used here for any transaction. In terms of your data being stored, all of these are decentralized. So in order for somebody to hack the system and manipulate the system, they need to take control of over 50% of the nodes. And as that starts happening, obviously the rest of the nodes would see that happening and can shut it down. So it's very hard to actually, from a security perspective, to break into this. Whereas like in a centralized organization, we all heard about, remember Sony got hacked into a number of years ago. Like all you need is one point of entry and you're into the whole system. With blockchain, because it's decentralized, you need to own 50% of the nodes. If a company is very successful, they might have thousands of nodes. So it becomes increasingly impossible to hack into it and take control.
Okay. I think
Great.
we're out of questions. And it's the top of the hour. So again, thank you to Atul for joining us. This has been great. I know I've learned some things today, and I hope our clients have as well. Do you have any closing thoughts? Or
No, I just find this is an exciting time. I mean, it again, having gone through the internet and other innovation cycles, I feel fortunate that we can go through another one. And one that can last the next 10, 20 years and has so much behind it. So I personally have more conviction in this today than I did a week ago, a month ago, a year ago, 5 years ago. And it's just exciting to see all this unfold. So.
excellent.
Great. Thanks again.
Thank you.
For tuning in to Asset Strategy and Accolade Partners today. Have a great day. Bye-bye.